Assalamualaikum warahmatullahi wabarakatuh. Today, me and my teammate, we're talking about the subprime mortgage crisis. Without wasting any time, let me introduce you to my teammates. In the late 2000s, a series of economic conditions came together to cause a major downturn in real estate and mortgage finance markets. This is bursting for the real estate bubble create a ripple effect throughout the economy, what is now referred to as the subprime mortgage crisis. The impact of the crisis will global in scale. In this module, we will look at what common mortgage practice in the United States leads to the crisis and how the government responds to the collapse. We will highlight some of the most prominent factors that contribute to the greatest economic pullback since the Great Depression of the 1930s. After investigating the cause of the economic recession, the discussion turns to how Congress responded with the Dodd-Frank Wall Street Reform and Consumer Protection Act.
Assalamualaikum. My name is Muhammad Faiz bin Mazalan. In this video, I will explain the subprime mortgage crisis. By 2007, the housing market had become oversaturated, with overpriced properties being acquired by people with poor credit histories. During a real estate bubble that people appear to expect will endure forever, lenders lent out exorbitant mortgages. As real estate values dropped, many of these mortgages were greater than the overall worth of the residences. Due to the falling real estate values, many homeowners found themselves unable to manage their monthly mortgage payments, and many were unable to refinance or sell their homes. Millions of Americans who were behind on their mortgage had no choice but to default on their loans. Between 2008 and 2014, consumers defaulted on their house loan in historic proportions, resulting in roughly 5 million homes being foreclosed on. Billions of households have been displaced, but how did this all come to be? The financial collapse that occurred from 2007 to 2009 is frequently referred to as the subprime mortgage crisis, since this lending practice is seen as the primary cause of the collapse. Subprime mortgages are defined by the Federal Reserve as loans issued to borrowers who are believed to have significant credit risk, generally due to a lack of a good credit history or other characteristics that are linked with high probability of default. The term subprime thus relates to the borrower credit rating rather than the loan itself. Subprime lending practices, in other words, extended mortgage loans to persons who would have been rejected credit under more conservative financial rules. Subprime loans gained popularity in the mid-1990s. In 1994, the total amount of subprime mortgage loans granted in the United States was $35 billion. That figure had more than doubled by 1999, reaching $160 billion. This tendency persisted after the millennium turn, and lenders were soon making dangerous loans worth hundreds of billions of dollars. Lenders provided $600 billion in subprime mortgage loans in 2006, only 1 year before the financial crisis officially began. In this context, it is probably unexpected that banks found themselves offering an increasing number of mortgages to people who were becoming increasingly unqualified. Not only were these loans made to riskier borrowers, but up to 70% of the loan application may have contained incorrect information. Applicants frequently make misleading assertions regarding their income or fabricate phony income verification papers. These misrepresentations frequently go unreported because to inadequate inquiry methods and the broader loose credit environment. Even though it is a very old issue, the impact of their rapid lack of credit resulted in a sharp decline in interbank transactions and a drop in stock prices, further undermining their monetary viability. However, the subprime mortgage problem continues to exist and is currently making a comeback as non-prime mortgage. Furthermore, it still carries a high level of risk due to the borrower potential for default. That's all I have to say. Thank you.
Lenders were willing to issue mortgage prior to 2007. Many in the industry assumed that if consumers couldn't pay their mortgage, they simply sell their home for a profit in the soaring house market and use the money to pay off the debt. As a result, lenders frequently use creative lending strategies to attract subprime consumers. This method mostly consists of teaser rates on adjustable rates mortgage and deceptive underwriting practice. Before the financial collapse, lenders commonly advertised adjustable mortgage with teaser interest rate. This mortgage offered low introductory interest rate for a brief teaser period, during which time borrower had lower monthly payment. For example, the most common type teaser, ARMs, prior to 2007 were 224 ARMs. This mortgage allowed the borrower to pay a fixed low interest rate for the first 2 years of repayment, with the remaining 28 years subject to an adjustable interest rate that reset every 6 months. In the early 2000s, nearly one-third of all ARMs had initially teaser rates below 4%. When that introductory grace period ended, interest rates skyrocketed and borrowers were often left with monthly repayment requirements they could not afford. Most prevalent among this type of mortgage were state income verified asset loan, where lender extended credit based on the borrower's state's income and asset level. An underwriter was required to verify borrowers' asset but not their income. Another common type of state income loan was a no-income verified asset loan, in which underwriter verified asset but did not look into whether the potential borrower was employed or had other source of income. No income, no job or asset loan, which known as ninja loan, were third and possibly most irresponsible type of claim income loan. Ninja loan may be accepted even if the borrower application lack financial verification. Without any independent verification of the borrower ability to repay the loan, ninja mortgage were issued. Unsurprisingly, a large number of these borrowers were unable to repay their loan. Low underwriting criteria facilitates the purchasing of house loan by people who face a real credit risk. Subprime consumers were frequently targeted for predatory loan with complicated and harsh terms. In fact, special mortgage loans were established specifically for individuals who couldn't afford a down payment. A mortgage lender would offer one loan to cover the down payment and closing costs, and then a second loan to cover the home purchase price in a so-called piggyback loan. Borrowers were able to acquire home with no money down and avoid paying private mortgage insurance thanks to this loan.
Assalamualaikum. My name is Muhammad Hazim bin Hussein, and I will explain about the impact of the subprime crisis. As we know, subprime crisis was caused due to housing bubble burst. It was occurred because too many borrowers, especially subprime borrowers, default their payment. When many borrowers default their payments, the number of house supply was increasing and the number of house demand was decreasing. Hence, the housing bubble was burst and the prices of house was going down massively at that time. As a result, subprime crisis was occurred and it leads to many impacts, especially in USA. Now, let's move to the impact of the subprime crisis. Firstly, in March 2008, an investment bank, Bearstearns, was acquired by JP Morgan Chase, which is a commercial bank, for $1.2 billion. Then, in September 2008, Lehman Brothers, which was fourth largest investment bank in USA, declared a bankruptcy on 15 September 2008 after facing a refusal by the federal government to bail it out. Furthermore, Washington Mutual is closed by the US government in the largest failure of a US bank. Due to that, its banking assets are sold to JP Morgan Chase for $1.9 billion. Next, the US Federal Reserve provided an emergency loan of $85 billion to insurance major American International Group, or known as AIG, which will be repaid by selling off assets of AIG. Then, Merrill Lynch, which is an investment bank, was acquired by Bank of America in September 2008 for $50 billion. Furthermore, US Federal Reserve granted approval to investment bank Goldman Sachs and Morgan Stanley to convert themselves into commercial bank. They convert themselves into commercial bank due to avoid collapse like Lehman Brothers. Next, US Treasury Department confirmed that both Fannie Mae and Freddie Mac will be placed into conservatorship with the government taking over their management. Then, Wachovia Corp, which was fourth largest bank holding company in USA, was agreed to sell most of its assets to Citigroup Inc. in a deal brokered by regulators. However, Wells Fargo, a commercial bank, drafted an agreement to acquire assets of Wachovia for $15.1 billion. Because of that, the deal forced Wachovia to backtrack from the Citigroup deal worth $2.2 billion, which was backed by the US government. Next, the market index, Dow Jones, posted its largest point decline ever, while the S&P 500 had its worst day since 1987, with an 8.8% drop due to the crisis. Furthermore, the US government had to release a $700 billion bailout package for its financial industry. Finally, the subprime crisis was led to economic recession in USA, which has affected the GDP, unemployment rate, and national debt. That's all for the impact of the subprime crisis. For the next part, we move to the Congress response to the crisis.
Hello, my name is Muhammad Firdaus and I will explain about Congress' response to the economic crisis. Congress enacted the Dodd-Frank Act in response to this condition with the intent of preventing a similar catastrophe in the future. The legislation was extensive, creating a new federal agency, the Consumer Financial Protection Bureau, and reforming practices in both the real estate industry and financial sector. Dodd-Frank overhauled mortgage lending practices, heightened oversight of banks and credit rating agencies, included a whistleblower provision that provides financial reward for the reporting of securities violations. Dodd-Frank Act was far-reaching law and it included the Mortgage Reform and Anticipatory Lending Act. as well as the Consumer Financial Protection Act. Dodd-Frank also mitigated a great deal of unnecessary risk in real estate lending markets and shifted more of the remaining risk of default from homeowners to lenders. Under the law, lenders sponsoring asset-backed securities must return at least 5% of the associated credit risk. He believes this requirement will reduce lenders' willingness to issue subprime loans, while this makes it more difficult for some potentially unqualified borrowers to obtain a mortgage. It is expected to improve the quality of the mortgage-backed securities being issued and support of healthier lending market nationwide. That's all from me. Thank you.
Hi, Assalamualaikum. Muhammad Fitri bin Muhammad Noor is my name, and I shall explain the conclusions. So to conclude this crisis, we can say without hesitation that there was no one cause of the late 2000 financial collapse. Rather than that, the economic slump is the result of a banking, lending, and a real estate market activity. However, mortgage-backed securities, collateralized debt obligations, and soaring adjustable mortgage interest rates on prime and subprime loans were the primary culprits. Congress reacted to the bust of the real estate bubble with the broad Dodd-Frank legislations, which includes the Mortgage Act and the Consumer Financial Protection Act. After more than a decade, mortgage lending procedures have developed to conform to the new standards mandated by the law. That's all from our group's discussions. We appreciate your time and thank you for watching.